Hello, good evening, everybody. Welcome to the 32nd webinar in the webinar series organized by Board of Internal Audit and Management Accounting. Today's topic is statistical ratios in internal audit. As we all know, internal audit is a very important factor in the corporate risk and governance area, and the statistical ratios help us to get a gist of the summary or the observations observed during the internal audit assignments. To address the topic, we have very experienced CA Dr. Paul Jaikar. I would like to briefly introduce him. CA Paul Jaikar is a chartered accountant with over 40 years of experience specializing in IT and risk management. He holds a PhD in Internet Security from University of Madras, MCOM and BCom degrees, and he has also secured 49th All India rank in ICAI Intermediate Examination. Currently, he is a director of IT and risk management services at CNK and Associates LLP, and also serving as an independent director at Panasonic Carbon India. He has technical expertise in the area of risk and information systems control and has credits from Health Zenith Systems USA. He has vast international exposure also, having completed assignments in the USA, Malaysia, and Sri Lanka. He has over 40 years of teaching experience also in the field of finance, IT, and management, involved with institutions like University of Madras, IITM, and IFMR Madras. He is also on the he was also the past president of the Institute of Internal Auditors Madras chapter and involved in syllabus committee at various educational institutions. He has also presented several papers at numerous seminars hosted by ICI, ISACA, and various universities. We welcome to you a great welcome to you, CA Dr. Paul Jaikar. Over to you.
Thank you. Thank you so much. Do we start off?
Yes, I think we can start. Yes.
Okay. Fine. I'll just share the screen. So this is the topic for today, where we are talking about a very specific area in internal audit. Actually, we have done this some time back, but now I've more or less retained the core, but changed the content a little bit. Because the field of statistics and it's called data analytics, data science, machine learning, and so on. That field has increased to such a large extent that number of standards have been released by the AICPA and number of people, that's ISACA and so on. Dealing with machine learning, or they may call it artificial intelligence, or they may call it audit data analytics in the field of internal audit. So that's the reason why we are going through this topic. Now, statistics by itself, we all know it's grown over a period of time. We have the international, the founder, the father of statistics. We have the local founder of statistics, and of course we have the adaptation of statistical methods and now machine learning also to the accountant, but basically it's finance. It's a large area of finance. You can talk about share market, investments, valuation, accounting, controls, continuous controls, monitoring. It's a large area, but anyway, it has come in, though it's a little late, but yes, it has stepped in, so we can definitely look at it. Now, I'm just going through this ratio because today, unlike the old days, if a student was told you're learning ratios today, and some ratio, we told him, current assets by current liabilities or something, whatever, some asset we told him and told him it's a ratio, they just kept quiet. But today we have a number of non-finance people getting into the audit because it's a lot of operational audits take place. It's not just finance, and finance is so advanced today that you may have management candidates also, statisticians, actuarial science people. For them, a ratio is A is to B, and a proportion is A by B. So basically, they're both the same. But we have got used to this A by B, that is A divided by B, concept. That is the first thing we have to convince our students about. The second thing is when we start comparing figures from different totally unrelated things or look like unrelated things, because we talk about big data today. So I got some simple examples on the screen, but okay, they're very simple. But see, Google, it's an old case because they're all public, internet published cases, so nothing confidential. So Google hides their data centers worldwide. In the US, they have the data centers located in so-called secret locations, which we are not supposed to know. We call them cloud data centers. They locate them. But one of these data analyst students, what he did was he started looking at external data. We call big data today. It's a fancy name. Basically, it's data other than Google's data. So he was searching for concentration of parked cars. You can get them from satellite view or Google Earth, or you can get from so many sources today. Then he started looking at pizza deliveries, which is also a public thing. Like you can have state-wise deliveries, location-wise deliveries. This is in the US. Now today, India also we can get that because Swiggy and Zomato and a lot of people hold that information. Okay, this is some time back. This is in the US. And then he started looking at power consumption figures from electricity utility companies. And okay, putting together for not just these three, but a few more parameters, he was able to arrive at a concentration somewhere in a desert where you have a lot of vehicles parked, consumption of this kind of, some kind of fast food, and heavy power consumption because of air conditioning and CPUs running. He was able to pinpoint very accurately the location of all the Google centers in the US without taking any data from Google. I mean, in the sense that he never asked the Google people, where do you locate your centers? Because they'll say it's confidential. Now, what I'm trying to tell you is today the auditor, the investor, the third party, in fact, our government uses a lot of these techniques at the CAG, at the GST, at various levels, income tax, um, immigration, sub-registrar's office. Okay, there are a lot of areas which is where it's used, where we need not look at an individual's personal figures at all, or a company's figures, yet you can get a lot of information. So that's the update which I really want all of us to understand, because as internal auditors or even statutory auditors, we get stuck with the what the company is saying, their books, their accounts, their whatever they have documentation. We need to look at others also. So that's the summary of this class. If you ask me in a nutshell, what am I trying to teach? I'm trying to tell you that by looking at some ratios, statistical ratios, we will be able to arrive at certain conclusions. Okay, so these are okay. We have got some height, weight, and okay, there are so many things we look at. Actually, it doesn't matter. I can share this with you. See, in the some earlier year, not this year, but some few years back, the government announced you can revise your income tax return up to 5 lakhs. You don't have to pay extra tax. Now, that is a statement, but unfortunately, nobody knew the repercussion of the statement. A few locations in India, specifically in the developed states, people started filing revised returns and then going back to the NBFCs and asking and the banks and asking for increased loan, because now the credit rating has gone up, the repayment capacity, because they use an outdated thing called debt service coverage ratio and so on, which is okay. They are very good, but today we have to look at a lot of other things, external data. Basically, nothing happened. The borrower's income now went up. It was a revised return. And then, of course, because you got a lot of data on the computer, you can model them and then find out it's a hoax. I mean, people are trying to cheat the bank or the finance institution. So what I'm trying to say is that sometimes unknowingly somebody does something, and that can affect somebody else, like an income tax revised return affecting the NBFCs and banks. That relationship we should work out well before the actual incident happens. Okay, now let's look at why they're okay. This is basically I'm trying to tell you why it's important and so on. But that we all know. I mean, basically, we all know that ratios are good because we use financial ratios, so it's easy to teach a finance class. Auditors, so we always use ratios. Now we have to look at another thing called probability. Now, probability simply means something can happen, something may not happen. So, whenever we pick up data from outside or we assign weights to the data we picked up from both outside and inside, we need to see how far the data is reliable. Normally, for this kind of work, the financial internal audits and operational internal audits and so on, 66% of the data, if it is good, I mean, if it's clean, that is accurate enough. You can draw very definite conclusions. You don't need 100% accurate data. So, because most of the data you pick up from outside will be corrupted. They say noise, but basically it means corrupted, missing figures, all kinds of things will be there because you can't get continuous data for 5 years or 10 years without disruptions in it. So 66% is one standard deviation. So if you have 66% of your data which is reliable, you can start working and getting very reliable ratios which you can interpret. They're very reliable. Okay, so now we take US because it's all publicly there. But today, India also has a lot of sites where this data is available. Mainly, if you want data, if you're learning, going ahead with today's class, look at data as from data.gov.in. So that's one place you could look at. You can get data from so many places, Yahoo, World Health Organization, United Nations. You can get data from, okay, see, a bank will not give you the data, but share market data is sitting there. You can always take it. If you pay some money to the ROC, you can get some data. So there's a lot of data available. Now, when we say fraud detection, basically this is historic. So I'm starting with that. So let's go through that. Now, we start by distinguishing between fraud prevention and fraud detection. So, fraud prevention will have to do a fraud risk assessment. It's a different area of your internal audit. But basically, let's say we're looking at the financial statements because today we come across a lot of students who cannot read the annual report of a company. So they just download, it's all free on the internet if listed companies, India and overseas. They download it, but then they just still work with the standard ratios. I mean, textbook ratios. We need to move away from the traditional ones and go on to the new ones. Data is plenty. I mean, we got plenty of data. We have, there's no shortage of data anywhere. We got plenty of data available. So we can definitely get the data. So we are not looking at prevention today. We are looking at detection. So what we are saying is if fraud prevention has failed, okay, then let's look at the detection. But that's because in your risk, you have audit risk, we say is an inherent risk, which you can't do anything about. Then we have the detection risk. Now, detection risk is what we are talking about. If the detection risk is, really bad, then you have to come back and look at these ratios. Okay, now the statistical methods we are applying, I'll give you all the formulae. I have the spreadsheet. I'll mail it to the institute. You can take it from there. Or if you need it, you can mail me directly also. Okay, now we need to look at these tests. Basically, these are done by researchers. Even now, a lot of research students work on it, but unfortunately, not being chartered accountants, that research is not used by chartered accountants, it's used by other companies like BPOs, investment banks, stock brokers, and there are different people who use those ratios. I'm trying to bring it to the chartered accountants. So here we have the organizational tests. So in the organizational level tests, what we have is two of them which kind of tell you whether your books have been manipulated, window dressed. Used to call it window dressing, but now we take the American words, whatever, falsification and so on. And we got another three ratios which are indicators that the company is not solvent. It's going to die. It's going to go insolvent. Because one of your Caro questions is whether the company can pay its debts. I mean, simplifying the question, can it pay its debts? So we call it some going concern, ongoing, whatever. How do you know it can pay its debts? Any of these three ratios will tell you that. So whether it's solvent or slowly, it's dying, it's decaying, atrophying. So I'll go to these ratios one by one. Now, Montier's C score is one of the ratios we need to look at. Now, all these are there on the internet, but only thing you have to do a little bit of searching because you have to specifically type each head. You can start with Wikipedia, but then move on to some better site where it's a research paper or white paper. I know they're heavy, but it's very useful. Now, this Montier's score, C score, takes a number between 0 and 6. Now, how do we get those numbers? Now, we want to look at 6 parameters. Now, this is all done by researchers. Montier's is the slightly lesser reliable. So, suppose you have only a doubt, try the Montier's. But if Montier's is indicating a red flag, then go to the next one. I mean, you have to go further deeper inside. If Montier is not indicating a red flag, then just leave it. So, we can see in statistics, we do have some tolerances, which I'll come to. So, we can't say that the moment we see a red flag, it's wrong. See, red flags can be errors also. It doesn't have to be a fraud. So that distinction, again, as I told you, when you're doing a fraud risk assessments, you need to understand the distinction between a red flag which is not serious and a red flag which is indicative of further problems in the organization. So these 6 parameters are, we look at the divergence between net income and cash flow. It is all there in your printed accounts, I mean your annual accounts, whatever you download the annual reports, because you need to have an income statement, which is your manufacturing, trading, P&L. You need to have a statement of balances, which is your balance sheet, and you need to have a cash flow statement. Additionally, there may be some ratios also. There may be a EVA and EPS, and those kind of ratios will also be there. Could be there. Okay, few are mandatory, but rest is left to the company. So we are looking at the divergence between or the difference between net income and cash flow. If there is over the last 3 years or 5 years, the gap is increasing. I'll give a simple example. Let's say I've got fictitious sales. So I'm booking the sales, but I have no cash. So I just increase the debtors. So what will happen is my sales will go up, my income is going up, but when I go to my cash flow, there's no cash there. So if the gap is increasing, then you have to assign a weight of 1. I will call it point, okay, 1 point. If your receivable days are also going up, obviously you're not collecting your debts, could be fictitious, or maybe you to increase sales, you gave more credit period or started lending to people who cannot repay. Well, that's 1 point. Inventory days, if your inventory is getting stuck, you're really in a jam, that's increasing in inventory days. Increasing other current assets, maybe it's all dead assets, you can't really recover. Then decline in depreciation relative to fixed assets. You're reducing the depreciation amortization so that you don't load the P&L with the expenses. Actually, there are a lot of they do. I'm not going to the reasons how they do it, but I'm just, as I explain, I'm telling you. Some of them will convert contingent liabilities to provisions, provisions to contingent liabilities just to boost the income up and down. That's okay. So there are a lot of things they do, but we're not interested in what they did. We're just interested in, can you rely on that, whatever the accounts whatever the accounts they have presented to you. Then asset growth in excess of 10%, you'll have to check. Again, it's a point. Now, none of these individually means anything is wrong. We put them all together and then see what number we get. So when you get the number, if there's 0 means nothing happened. And as it's going towards 6, 6 is the highest, because there are only 6 heads we got here. So if it's going towards 6, then there is a very strong red flag that your accounts are window dressed or manipulated. So this is the first thing you would do. So this is on the first step, the Montiers. Now, if you want to go a little more deeper, then you get into the Benish M score. If there's nothing wrong, just leave it. I mean, the accounts are okay. But if you're not happy with it, then you go to the Benny score, where you have 8 indices capturing different financial data points. Now, the actual data builds the calculations, etc., which creates the score. And we will look at the formula now. See, if you see these weights, minus 4.84 plus 0.92, 0.528. Now, these weights have been taken from the Asian market. I just tried to put in the Asian market. I don't have any student doing anything on the Indian market, but I guess we could find somebody who wants to do research on this. We'll have download tons of balance sheets, sick companies, bad companies, good companies, and then arrive at these weights. It's very reliable. But anyway, even if you use the Asian score, I'll show you the last slide from Wikipedia. It is showing fairly accurately for Indian companies also. See, Asia means only basically three, four countries: China, Singapore, India. Basically, these are the only major countries. Others are like very small. So these weights are decided by the researcher, and we put it here. Then comes each of these DSRI. I've got the explanation here. Day sales in receivable index, GMI, gross margin index. Okay, the names are American, but we can change it. Asset quality index, basically index means nothing, ratios. Okay. Sales growth index and so on. Now, when we come, actually all these leverage index people work out, and the stockbrokers and investment treasury departments also, banks and NBFCs, they work out, actually they work out all these ratios. Now, only thing is we have to put it into an equation with the specific weights, and some are subtracted, some are added, and this M is the final whatever answer we get. Now, whatever answer we get, we have to interpret. If you get the threshold value is minus 2.22 in some internet sites, I think it's because of the HTML. The minus has got skipped, but just remember the minus is part of the answer. The correct, neutral answer is minus 2.22. And then whatever answer you get, you have to interpret, and we all know at least the basic maths. Let's say I have minus 5, then minus 4 is greater, minus 6 is lesser, if you have a minus. So in the minus part, unfortunately, the lower numeric value is greater and the higher numeric value is lesser for the minus part, negative. I mean, that's the easy part. That's not difficult. The tough part is to put all those numbers into the equation and figure out the number. So once you got the number, then you look at it. If you have the calculation, okay, it's greater than this value, it suggests a higher probability of financial statement manipulation. If it goes less than that, it's fine. Because we have a much, if I go to the first one, where we had only 6 basic parameters and we just give 1 point. 1 is the weight. But now when we go to this Benish, we have got weights which are all in decimal points and have been worked out, more research. So obviously, it's more reliable. And you've taken more number of parameters also. So your interpretation will be more reliable. Because one of the questions your audit committee will ask is, how reliable is the interpretation? The ratio is good, but how do you say that this is right or this is wrong? So we need to have those answers also. Now, okay, now suppose you have totally, okay, a little, this red flag is also there. First, we got the red flag in the Mondias, then we got this in Benish. Now go to the Altman. In fact, in almost all the, whatever SFI, okay, so, okay, wherever they use it, CAGs, they have investigations, okay, whatever. They would be using Altman because even in big BPOs like, okay, the big BPOs, okay, JP Morgan, whatever, they all use the Altman because this is far more reliable. Now, this is a linear combination of some business ratios. Again, you have your formula here. 1.2 into some was first parameter, 1.4, etc., second parameter, and so on. Now, what are those X1, X2, X3? It's your working capital to total assets, retained earnings to total assets. Okay, whatever I'm just reading out from the slide. So it's before interest and taxes too. Okay, whatever. You can just read it. There's no big point by reading it. Anyway, the point is we have got some very basic ratios here. But if you notice, they're all different. From working capital is completely different from retained earnings. That is completely different from taxes and interest. And that's completely different from your equity. And that's completely different from sales to assets. So the researcher has taken these five different aspects of the financial statements, form some answers, assign weights to it, because here you're adding everything, nothing to subtract. And once you've done that, you get an answer. So if you get, like if it is 3, actually I've taken the accurate number from maths kind of stuff, but actually 3 is good for auditors. So 2.99 means your company is fine. There's no problem. But if it falls to any area below 2.7, then the company is really bad. It's going sick. I mean, it's going to become insolvent. It's not a question of manipulation, it's also dying. If it is somewhere in between, okay, then between the 3 and this 2.7, okay, then it is kind of deteriorating. If it goes below 1.8, it's completely insolvent. Normally they plead insolvency. So that's what happens. Now, if we go to the next one, this is the Olsen's score. Now, this is a multi-factor financial formula for, again, bad management or bad cash flows, or maybe business got nationalized or taken over. I mean, various things happen. So you open an airport in a foreign country, it gets nationalized. You're depending on tourists and tourism drops. Okay, so many things happen. They are all predictors of financial distress. So again, if you see this formula, it's again a long story out here. But what I have done is I have copied this from the internet and put it here. So you can see it as a numerator denominator formula. So the T indicating the time period. And if you see a T minus 1, like okay, here, this is N and this is T minus 1, it's the previous year. Whatever year you're talking about, it's the previous year. Why is it T? That's the basic compound interest formula. So if you go back to accounts, the formulae were never found by accountants. They were all done by mathematicians, annuities, compound interest, whatever. I mean, there's so many things you studied. Net present value. Okay, there are so many chapters to study regression. So we label it off as financial statistics, business statistics, financial maths, whatever we call it. So basically, the mathematicians have their own terminology. We have our own terminology. For us, N is years, but for them, T is time period. So, okay. So anyway, that's what it means here. LOG is the logarithm. You can, now we have spreadsheets. You can easily get the log of all this stuff. No, not all, only the first one. There are interchangeable pluses and minuses all over, so you have to be careful. And wherever you see this, like, okay, NIN minus NIN minus 1, etc., it's got a little broken. But that's where I told you it's like this. You can see it over here, numerator, denominator. So when you actually, I'll give the spreadsheet template also, but feel free to tamper with this. I mean, meddle with this. So I'm talking more from an academic point of view, research and so on. You can use it for your regular serious work. I mean, so you can use it. If you're in industry, I'm sure you're already using it, but if you're in practice, you could give it a try. So here we have all this stuff like TA is total assets, GNP is gross national product. Okay, we have some external factors we're including, because one of the things you compare is, for instance, when somebody teaches BCom, what they say is, if you get a liquidity ratio of say 2, asset test of 1, your company is very good. But if you take India and we take our GDP and then look at it, we need at least 3.6. If you're lower than 3.6, you're not solvent. I mean, you're not good, not liquid. So how do we get that 3.6? We are looking at GDP. GDP is the country's statement. Company statement is our own companies, whatever we got from the internet or where we work. And then we compare. So that is why you bring in Actually, the correct name for these is called macroeconomic parameters. It's a huge study. So, um, I mean, academically, it's very huge, but practically, just restrict it to what is practical. So, for that particular organization. So, if you're dealing with an export company or an import company, GDP is very important because you got currency problems, you got all kinds of problems. So, then liabilities, we understand capital, working capital also, you'll have to look into your own organization's definition. Current liabilities, current assets, we understand. Okay, then we got this net income, funds from operations, and so on. Okay, now once we have done all this, then we go ahead. And if your answer is greater than zero point 0.5, then you have something which is a firm will slowly sink, and of course, if it's less than zero point 0.5, then you're doing well. Now, Olson actually is used by Wall Street quite a lot. Okay, the logo is out here, but that's okay. But Wall Street is, replicated in many of our BPOs in India. We have almost all of them. We got all the big banks. We have all the big mutual funds, big ones, mean all this foreign stuff. We also have our local big mutual funds, like whatever, okay, like Tata and Aditya and Birla and so many. Okay, there are so many of these. Now they will be using all these in their internal audits internally, but you can start using it for your practice also. Now this Pytrosky score is a little more complex. As I told you, every time you get a red flag on the previous one, you want to go deeper because you have to convince your whoever appointed you to be the auditor, the bank, maybe investor, maybe it's a company itself, the audit company. You need to have conclusive evidence that they'll ask you, why didn't you check the books? But yes, I looked at the final figures and I know the books are cooked. Only thing is, you have forensic to find out where it is cooked. That's different. Okay, the only example I can give you is there was an allegation that Infosys was fudging accounts in the US for they're listed on the NASDAQ. New York Stock Exchange. So somebody said, look, these Infosys companies cooking their books. Obviously, it's a serious allegation. So, and you have class action suits, which means share buyers and sellers over the last 3 cycles or 5 cycles have rights to sue you. So they appointed a consultant, and within a matter of I think less than a month, consultant said there is nothing, there's no fudging of books. At that time, if the same problem happened in India, where a big team would have come, pulled out all the account books, vouchers, whatever. I mean, billing. They would have made a mess of everything. It'll take months, maybe sometimes years also, but at least months. Now, out of curiosity, if you want to know how they did it, they went into all these ratios. So that's also, um, as and for ongoing learning, whenever we see something going wrong, we also want to know what methodology was used to say yes, something was wrong, or no, something was not wrong. It's like medical diagnosis, COVID. If you see the data, they started eliminating certain they call them parameters or data points, and they started adding new data points. So ultimately, what happened? We got our vaccines, we got so many things. Humans started getting immune. So same thing applies to our accounts also. Nothing really different, except that unlike a pandemic, nobody dies here. Finance, nobody's going to die here. But it's the same logic if you ask me. Because see, as a statistician or a mathematician, you don't look at rupees differently from apples or horses or buildings. They're all the same to you. They are numbers anyway. So, okay. Now coming to the slightly longer story here, we are going to work on 9 criteria. There are 4 of them in the first group, 3 of them in the second group, 2 of them in the third group. We are given a lot of emphasis on the profitability. So return on assets and operating cash flow and so on. Now, this is again, something like we did in the first one, Montier, just give 1 point if it's positive, 0 if it is not positive. Again, it's only 1 point we're getting. That's how we get is 0 to 9. Now, if you finish with profitability, then you're looking at liquidity. Now, liquidity is one of the most difficult things to identify because maybe I got something to really sell, like gold or whatever, diamonds. But suddenly there's a glut in the market, or maybe there's a ban on the import or export, or something happens. I sit with a lot of stuff which I thought was real saleable, but it has no value because there are no buyers. Same problem happens with the oil reserves. Same thing happens. Suppose, like for instance, nickel cadmium was the original rechargeable battery raw material. NASA had done it somewhere in the 70s. But then they said it's poison, so it went off. Now, what happens to all the people who are mining cadmium and nickel and all this stuff? Companies closed, died. Now we are looking at this Leon batteries, lithium. But now we're saying lithium is also poison, this, that, something. So it may also die. I'm not saying it will die tomorrow, but it may also die. You're looking at hydrogen fuel cells, which uses water. So given that the industry is dynamic, research is dynamic, people's trends, instead of going for traditional long-term insurance, banking, they go for mutual funds, SIPs. You see a shift. A lot of things keep happening. So traditional companies, I'm not saying only traditional, even startups cook their books. For startups, we have separate ratios, okay. But anyway, for share market, you have separate ratios, capture ratios, CAPTURE. You people, researchers keep on working on these new ways of detecting something right, something wrong. Now, we are just concentrating on the audit component today. So, for the solvency part, here we are. We look at the change in leverage and current ratio and so on. That's a long term, short term. Then, operating efficiency, we look at basically the gross margin and asset turnover ratio. So, these are the ratios we look at. One, if it is higher compared to the previous year, the PY is previous year. Otherwise, it's a zero. Now, with so many factors, you will be getting some answers. Now, if it has a score of 8 to 9, it's good company. The number drops, it's a bad company. Okay. So that's what your result is. Okay. Now, when we look at, when you look at the tests you want to conduct, we say identity, location, frequency, and the amount. Now, certain countries suffer from hyperinflation. Now, India does export to certain African countries, motorcycles, buses, trucks, whatever, different companies, medicines. Now, we need to look at location based. That's why I said GDP was just one of them. You may have to look at hyperinflation. There are a lot of other data we need to look at. And we have to be very careful that we have the weights we are assigning is right. I mean, it's not taking all of them as equal. Then how frequently are you running these tests? I mean, are you going to do it on a continuous basis? Like your, okay, like I'm just using it's not a good comparison, but technical analysis for shares, your candlestick method or whatever. Is it like that? Or are you going to work on quarters, half years? And what is the amount you're working with? Small values, huge values. I mean, I'm not supporting anybody, but they said in the Zomato warehouse, they found products with a future manufacturing date. Out of crores of rupees of products, 7,200 rupees worth of products had a future expiry date, I mean, manufacturing date. Zomato owner says that it's a mistake by the supplier who probably punched the wrong date or whatever. It's a very low value item. We don't know if it's critical, but he says low value. Now we need to look at is it material? Okay, this material concept keeps going confusing all of us. But if that 7,200 rupee type of stuff, whatever it was medicine, important medicine, cancer medicine, then it's important, critically important. But if it was something which really didn't matter, like washing soap or something, that's okay. So that's why an auditor will have to work with a lot of risk assessment first. And then once you got all this, okay, then fine, we got so many ratios we can use. Now, the second level is once I mean, you're convinced there is some solvency problem or some fraud manipulation problem. Now you have to start looking at other things. And the other things you have to start looking at is Okay, these are the statistical tests we run. Traditionally, there were some tools like ACL, audit command language. There was a audit program which was sold. Then we have IDEA, that's also another audit tool. But over the years, we don't really need those tools. Of course, we still use them. People still look at it as very important. But basically, today you can use any graphic analysis tool or visualization tool. There are four of them which are very popular. You got plenty of them not so popular. You got the Power BI. Desktop version is free. You can download it from Microsoft. You can download it, use it. Power BI. Then you have Tableau. Again, the cloud version, trial version free. Then we have ClickSense, QLIKSENSE. They changed the name. Okay, that's okay. ClickSense. You can use that also. And there is one which is not really picking up in popularity, but it's a data mining tool with visualization. It's called KNIME, KNIME. If you're having lots of data, tons of data, like you have crores of records or lakhs of records, my suggestion is don't go for sampling, which we used to teach, and it was very important because in those days there was no facility to process such large volumes of data. But today our PCs are quite powerful. All these tools I mentioned are powerful. Excel will be a problem because it has a limitation on the number of records, so that's fine. But all these tools I mentioned, some people write their own code in Python. That's also fine. You can download, or you can ask ChatGPT to generate whatever audit test you want, generate it in Python or R. You can use it. There are a lot of solutions we have today. So we don't have to really struggle with samples and Excel and so on. So one is our classification. Now, data has to be classified. Now, how do you classify? Now, you classify it based on what you want. Maybe looking at time-based something. It's over a period of time. You're looking at value-based something. You're looking at purchase prices in tenders, auctions, whether the difference is a kickback. I mean, some doubts you have. You may be looking at location-wise. They call it geo spatial data. Or you may be looking at it from product type-wise. You know, we classify products as consumer products, industrial products, and so on. For instance, washing, whatever liquids we have. Domestic also we have washing liquids. They come in small containers, 1 liter, half-liter. Industrial floor washing, they come in gallons, drums, and so on. So anyway, that's the classification part. More on this, if you just look up Google or Chat GPT or any chat, I mean any GPT you like. It's generalized pre-trained transformer. Any GPT is fine. If you want actually you can use the 4.0, but you had want the paid version, it's $20 a month. So unless you really need it, you don't have to pay the $20. You can use it free that till you really want to go for the paid version. Then we have the statistical parameters. Now, this is one of the things which you do where parameter simply means limits for in this case, in this context. What is my normal thing? So once you see an exam, say 4 papers in a group, theoretically each paper is 0 to 100, I mean, marks wise. So 4 papers. So each paper I would have had a test. Is the mark greater than equal to 0 and less than equal to 100? Fine, there's no problem. What if you take the total of the 4 papers? There's no 0 to 400 because we know nobody will get that. Maximum normal marks will be about 70%. Okay, maybe now we're getting some eccentric, slightly better marks, but okay, let's say 70%. Then I'm going to only check for 0 to 280 when it comes to the total. Anything above 280 is called an outlier, which means it's not wrong, but it's not falling in the normal limit. So I pull out those students' marks alone and re-examine them, whether any typing error. Suppose I typed 38 as 83. Obviously, the marks will go up. So that is the outlier part of it, statistical limits, parameters. Then numbers, how do we stratify numbers? Now, normally when we do a standard classification, we say 0 to 10, 10 to 20. No, we'll get the classification, no problem. But see, what happens is we need to look at where the numbers are concentrated. So if a normal sales value is around the mean, or let's say I'm somewhere on the center of our 0 to 100 is my invoice values. Most of the invoices are say 40 to 60. Then my stratification 40 to 60 will be more detailed. 0 to 40 one group, 40 to 45, 45 to 50, and I'll do that till I get to 60. Then 60 to maybe 100, I take another go. Because the lesser value stuff, I'm not really serious about. I more see what happens is, if you look at frauds, they will travel ticketless in a crowded bus. When there is a heavy traffic on a network, they try to break into your system. So they're always looking for that crowded area where in your distribution, if you see, where the volume is high because see software, computers, people, they all get stressed out. I know this problem. If you arrive early for a meeting, the security guy will check you completely out, your shoes, your bag, everything. You are almost on time. You're just walking in. So everybody's just going through a routine. It's more like a ritual. So we know frauds take place when data is crowded. So that's why a stratification should not be an equal class interval. You stratify them. Then joining random diverse sources. This is what I told you when I had Google big data, auctions data, travel data. You'll have to look at a lot. See, all trains coming on time, but your taxi guy is saying no passengers. Obviously, he's canceling the bookings and he's taking them out of the system for cash or something. Then that will not match. If no trains were coming in, heavy flood warning, trains cancelled, taxi fellow says, I'm not getting anybody at the station or the airport, that's different. So that's why you need to look at the, when you say random, it's not technically, it's not random. You'll have to identify the relationship. Now, duplicate testing is a routine stuff because, but it's not always wrong. See what happens in site offices, they're small suppliers. That fellow starts typing invoice 1234 this month. He's using Word, probably something small, nuts and bolts or something is applying. Next month again, his operator does starts typing 1234. And maybe the purchase is always a fixed quantity. So it will show up as duplicate invoices, sometimes same dates. Mostly dates may be different, but everything else is the same. You have to be careful. So when you stratified itself, you should have considered that. Then missing values, where the people have actually removed data, particularly in log files, audit trails. Now it's mandatory from a company law point of view. Your IRDS circular and RBI circulars talk about all this for the logs. But when it comes to your financial data, gaps you have to check because they may be genuine. I mean, see, we're not saying everything is a fraud, but it's a red flag. So if there are gaps, you'll have to see what happened. There may be, you buy and return. There was no purchase, no return, just fictitious book entries. Even in ERPs where configuration is poor, people can manipulate it. Entry dates validation, of course, they have this period locks and earlier data and later data. And also you have this closing process, month end, week end, whatever, quarter end. You have to be very careful that the closing, whatever entries and whatever routine they have gone through is absolutely accurate. Now, the closing part is very important because otherwise you will not know whether they are closing it correctly and reopening it immediately. So actually it happens in intercompany deposits. A lot of places you have to ask them to close it and reopen it in the next period. Just see if there's no fraud, it's fine. Otherwise, you can check up. Numeric values summation is totals. We have financial totals, record count, hash total. You have to keep adding up. Okay, again, simple example. Now let's assume that we have say a bunch of checks you want to send out. You count the number of checks. Let's say 100 checks in a bundle. So the physical count or the record count is 100. Then we total up the values of those 100 checks. So that's the financial total. Then you start totaling up all the check numbers. They are numeric and they are unique. So you total them up, you'll get some answer. That's the hash total. So if a check is lost, let's say they removed a check and substituted with a higher or lower value, two things will happen. Your record count will tally, but your financial total will go wrong. Your hash total will go wrong. They had the same number of checks, same amount, but they changed the name of the person to whom this amount goes, beneficiary. Then, when the check is tampered with, now the new check is substituted. Your record count and your financial total will tally, but your check number total, that's the hash total, will not tally. These are today, because of computers, these are routinely done. Any batch processing or even we say uh, real-time systems, but we call it as batch entry for subsequent processing. So batches can be 5 minutes, 10 minutes, half an hour. It depends. Also, we say don't mirror the data, because today we have new problems like viruses, ransomware. So if I'm copying my data immediately across two systems, I mean real one, I mean the actual one and the backup one. If I am attacked in the first system, if it's attacked, the data which is being backed up is also corrupted data. It's either encrypted by ransomware or something is wrong. So you give a small time delay. That's of course the company has to decide, 5 minutes or 10 minutes or whatever the time delay. It's called synchronization of backup, so that when there's an attack sensed in the first system, you disconnect because you have to go offline immediately. The second system's data is good, but it's 5 minutes behind time. So that you can easily recover. You can retype or re-enter. Okay, something can be done. Okay, what we are trying to say is newer threats, the name remains the same. All these 8 names are the same. I would safely say for the last 30 years, where India has been using ACLs, and idea came a little later, or Excel, Lotus 1, 2, 3, whatever. Names are same, but volume has gone up. The type of threats have gone up, and of course, newer frauds. Yes, frauds are also innovative. It's a profession. They keep trying to find better methods. So what we are now trying to say is, if you have an execution level, which is at the x-axis, and a test objective on the y-axis, test objective, if you see, you've got functionality, security, performance, conformance, reliability, maintainability, etc., etc. Okay. All these are dictated by the internal audit. On this side, this is dictated by your SDLC, that's software development lifecycle. Today they call it SSDLC, Secure Software Development Lifecycle. Why should it be secure? Because there's a concept called shift left, where the design of your software itself should, should include security right from feasibility study. Supposing a feasibility study says, oh, look, this data cannot be kept safe, then don't even collect the data. Keep it manual or do something till technology increases and finds a solution to that specific problem. So what we are trying to say is the type of testing has changed. Earlier, I would have taught you black box, white box. Okay, some all kinds of stuff, stress unit. They're all there, but they all gone to the software guys. Now, when it comes to the auditors, they do static testing, SAST, SAST. There are free open source tools online. You can download them. Take a code. If you don't get a code, just download it from, just ask for a Python program to do something, some small problem. You'll get the code, put that code in this program. It'll try, for instance, I have input number of employees. I mean, it's a statement I've got in the program. Then immediately I take number of employees and do something. The SAST tool, SAST, static analysis, what it will tell you is, after you receive the number of employees, between the two lines where you receive it and start processing it, insert more commands where you check whether it's a number, it's positive, and so on. So that's the static testing. Now, dynamic testing is you run that with data, not just the program. You got to execute the program, because these tools you may not be able to download, but there are not cloud, there are online sites. Even HCL has got a site where you can test it. I mean, run it online, like you're running your online speed test or online hash test or whatever. You can run it online, but remember the only problem is with online, the data goes to the server of this whoever is giving you this facility. Suppose it's client's confidential data, mask it. Make sure it's not identifiable. Remove employee number, name, this, that. Just have A, B, C, D, whatever, some names you have. You can run it to the cloud site, but uh, don't run actual data. That they see, because people collect data. They're not against you. They're collecting data to do their own research. Even right now, Zoom will ask you, I'm going to record this thing, whatever you're doing, for AI purposes, it says. So fine. I mean, they have a right to do it, so that's good. So let's look at this dynamic testing, but a tool will cost money. If you want free, it's only online. Runtime monitoring is continuous controls monitoring. where it used to be a subject long back. We used to have this audit hooks and embedded audit modules and all that. Today, it is same concept but much bigger. So while your software is executing, you can do it in, they call it audit feature. You can enable it in most of the ERPs. You can enable it in most of the machines, let's say boilers or furnaces or wherever. You can do that, and your program is monitored all the time. It's called continuous control monitoring, particularly when you have parallel controls to be monitored, like A or B or C can approve it, or A and B or C can approve it. There are some various combinations we'll end up with. There are other times when the first control, okay, we have some bank has got a letter of, I mean, they've done a credit check on you. They got the loan origination stuff. They got this, they've also informed you your loan is ready for dispersal. And then there's the actual dispersal. So there may be time delays. This happened maybe 3 days ago and something else, and then maybe 5 days later, dispersal took place, or there may be a robotic process automation where it's entering data into the system through email, from emails or QR codes. Then runtime monitoring becomes important. Okay, all the story here on the auditors testing tools, all the story here on the audit requirements for the data quality. Okay, when you're talking at the first level working algorithms, so we have to learn some. I taught you a few statistical algorithms. That's okay, we learn as we go ahead. Then what are the components we are testing? That means individual data, or are we integrating it? I'm not interested in quantity and the price. I want to look at the value. That is internally I'm multiplying. Or I may be matching employee addresses with product supplier addresses. I suspect a fraud, ghost employees. I'm trying to check PF something data with my employee data. Then comes the entire system you're auditing. Then you're right there. Okay, you got everything correct. Again, to be very frank with you, large companies with okay, a few lakh employees, normally you won't be able to balance anything of the employee count, because there are contractors, there are discrete systems, there are biometric, swipe card, manual registers for attendance, leave portals are there, or leave letters are there, approvals go from different people. See, what happens is getting this payroll stuff done is a nightmare. So it is then all this makes sense. But like we have to learn, we have to study. So supposing I'm doing biometric things, got false rejection rate, we got false acceptance rate, FRR, FAR. What's the algorithm I'm using? How reliable is it? Because in one case they said that in North India, the for certain festivals they put mehendi on the fingers, and so the biometric won't read. It's a red flag. And then we don't know it's true or false. You have to check. Then they said, I mean, when laborers are working, their hands are dirty. So the biometric won't work. See, there may be ghost workers because, say a common name, say from South, say Munsami. It's a common name. I mean, you can tell the worker when they ask you a name, you just tell them. So we have problems here. I'll give you another example in Port Trust, where they bring these loader coolies, I mean, gang coolies, 2,000 workers, 3,000, they work 3 shifts. Okay, let's say a particular, some problem, grain loading. They got 1,000 employees, 1,000 loader coolies per shift, 3 shifts, 3,000. What this fellow will do is he will buy only one set of passes. He'll buy 1,000 passes to enter the port. Now, what the exiting coolies will do is give this pass to the next fellow. His agent will go in, make sure the passes get transferred to the next crowd, next crowd. Instead of 3,000 passes, you're selling only 1,000 passes. Based on the data, the company insured only 1,000 floater policy only for 1,000 workers. Major some catastrophe, something problem. Then you suddenly find 3,000 fellows actually work on that ship day and night. So whose fault? They'll blame the auditor. They'll say you didn't check. So that's why the bigger the problem, bigger the risk. So anyway, I hope these are all pictures, easy to explain. But in real life, it takes a bit of work. So you have to work. Now, I just thought I'll introduce this also, which is called the hidden Markov model. Normally, a Markov model tells you which which event or which type of activity affects some other activity. Like you are giving free food, free lunch for students, their attendance improves. Everybody is happy, more students coming to school. But the problem is, are they learning anything? So if you're doing a government grant kind of audit, there is a financial aspect to it. There is this attendance aspect to it. There is also a social aspect to it. Is it improving the quality of students? Now, that is a difficult audit. So, because we need to look at the influencing outcomes. Are they coming there to eat? Or because you're giving them food, they're studying better? Is their memory improving? We look at it in two ways. If you look at the UNDP data from Africa, they feed the right from the baby stage because they have no food. Certain countries, not all. You can see their belly is very big, the liver is damaged, acute starvation. There, the food makes a lot of difference because the children don't become mentally retarded. But if you take, say, some other state in India, if you're giving them free food, they are not babies. I mean, they're first standard. I mean, they're already 5 or 6 years old. They are coming there. They learn something. That's not whatever ABC or whatever the local language is, 1, 2, 3, and so on. Now there we can definitely look at not who's getting mentally retarded and who's not, but who's learning better. Whereas in some other countries, as I told you, that identity, location, there's so many factors we have to consider. The factors are completely different. Now we have to consider these things because in software companies, not all, but some, where people are highly paid and they give them free lunch, all these chaps go outside to eat. So basically, doesn't serve the purpose. So anyway, whatever it is, each audit will be different. So the same people, same food, but in different contexts, locations, your audit points will be completely different. In the software company, you'll say you can stop the lunch. In the school, you'll say, whatever, okay, give them tea also so they stay back a little longer and study. Maybe if they are basically babies and children, then you'll say just feed them and forget the rest of it. I mean, don't look at what they are learning. So what we need to know is, are they hidden stuff? So to explain this, earlier I used some theoretical explanation. It didn't work. So I'll take a small example. Now, see, we have to slowly bring machine learning. Okay, so that's okay. That we will do. I mean, some other class will do that. Now, I've taken a small case. This is of the internet. So now we got two people, A and B, Alice and Bob, whatever, A and B. Now, what they are doing is they're talking to each other, but they're physically apart. They're different places. Let's say one's in Delhi, one's in somewhere, okay, let's say Chennai. So they're physically apart, but they talk on the phone, they're good friends. And only thing they talk about is what did they do. Now, the activities is walking in the park, shopping, and cleaning the apartment. So the only three activities we have, you will talk about it. So how was the walk and or how was the shopping experience or how was the cleaning experience? Now this is one part of it. Second part of it is you have no definite information about the weather, but the weather and these activities are related. If it's raining, you're not going to walk in the park. If it's not raining, you will definitely go walking. Shopping this way, that way. Okay, so maybe raining will shop, not raining will shop. But if you're cleaning the apartment, obviously it's not. It is raining heavily, and you're not interested in going out, so cleaning up your house or whatever. So now we have two things. One, the discussion between these two people will definitely tell us what is happening. Are they walking? No, not they. One person. That is Bob. Is he walking? Is he shopping? Or is he cleaning the house? What Alice doesn't know is, she knows this part, what he did today, she knows. But what she doesn't know is it raining, good weather or bad weather? That she doesn't know. Now, based on the data she gets from Bob, now she has to guess the weather. Actually, I would suggest if you go for data mining, it's a lot easier. But anyway, I'm just explaining this. Now we need to set up, see, data mining tries to find the patterns. That's why I suggested KNIME. Here we know the patterns. These are mathematical stuff. So here we know the patterns, so we're working on it. But as auditors, this is too much work. So best is give all the data to the machine, ask it to figure out the patterns. Maybe wrong, maybe right, but see, you have to work with 2/3. That will be fine. If it's more or less showing you some pattern, that's the pattern, you can accept it. If you're doubtful, then try it for another year, previous year, one more year before that. You get some answers, so that's fine. But make sure those 3 years or 5 years data, the operations are fairly same. If 1 year it was manual, second year it was automated, things will change. Okay. Now we need to know from the activity, we need to know whether it is rainy or sunny. This data is not shared by Bob to Alice. The walking, etc., is shared. Weather not shared. Can we find the weather from the activity? That's the question. Now, if we go to the equation here, this is a Python program which explains clearly. There are two states. State means like, okay, this one or that one. We got a rainy state or a sunny state. The observations we have, this we get. Observations we get. We have from the observation, you have to guess the state. We don't have to guess, there are models for that. We have walk, shop, and clean. If I say walk, you should be able to predict, is it rainy, not rainy, and so on. The probability is rainy is 0.6. The probability will only be between 0 and 1. It won't be beyond 1. It won't be less than 0. So probability rainy, sunny, we have got 6% or 60% of the time the weather is sunny and 40% of the time it's rainy. Now the transition probability is rainy to sunny and the sunny to rainy. You start rainy, it continues to be rainy, that's one probability. You start rainy, it moves to sunny, well, that's another probability, and so on. Now the changeover we have got from rainy, walking is only 10%, shopping is 40%, cleaning is 50%. So these two take a bit of a almost equal value. If it is sunny, walk is 60%, shop is 30%, and clean almost 0, 10%. So these are the data given to us. Now you can run this if you want in any Python compiler. Now we have this diagram. Don't worry about all this. This is all the math stuff I'm explaining. You use tools. I mean, something like, there's so many tools. We use Excel. We just put the formula there. Type the function. You don't have to learn the formula. Use a calculator. You just type the button. You don't have to know the formula. Maybe I'm overdoing it, but I'm not scaring you. All I'm saying is, if you learn this, it's good because then you will know reliable formula and less reliable formula. If you don't learn, it doesn't matter. See, we'll have threshold, like it showed the ratios. First red flag, go to the second formula. Then for the insolvency, first red flag, go to the next formula. So you can use multiple formula. Machines do it very fast. So we got these three things here, rainy and sunny, two things states. We got the three activities, walk, shop, and clean. We have these probabilities which you saw in the previous 0.1, 0.4, 0.5. Okay, they're put in different colors, they're blue and red and all that. And then we need to guess, is it raining, is it whatever. These are called flow charts or Titian diagrams, whatever. Just don't worry about it, but spend a little time on this. This is my only request because maths is not as difficult. Maybe we don't like it, but it's not so difficult. We can learn. Actually, if you ask me, learning accounts is much more difficult at the advanced stages. This is pretty clean maths. Okay, so now if you look at starting with technology, you understand the business process for which you draw a different type of chart. Nowadays, the clients are asking for UML charts, Unified Modeling Language. It was used only by the software people, designers, programmers. But today, many people in the internal audit of whatever production, services, basically manufacturing, logistics, banks, they are not accounts-based people. They are all engineering or mathematician or management, engineering with management kind of people. So the business process, they are not asking for olden days. We had run flow charts. Even now in internal audit, we use a run flow chart, system flow charts. But now they're asking a very detailed comprehensive diagram. Either it's BPMN, business process modeling, business process mapping. Okay, business process mapping notation or modeling notation. And the other one is UML, Unified Modeling Language. Maybe we could spend a little time learning it. Not very, I wouldn't say it is absolute essential, but would be useful if we learn it. Or at least it'll help us to understand somebody else's diagram. That's important. So we identify possible frauds. We had the ratios. We saw them in the beginning of the class. Then you catalog the fraud symptoms. Then use technology to gather data. That maybe we have to do it some other time. There are 4 or 5 steps where you use to clean up the data, make it usable, and even you can merge data also, both internal and external data. We can benchmark it against national numbers or industry numbers or whatever. We can do that. Okay, the last part is you analyze and you follow up. Now, when you are using this follow-up and analysis and follow-up, I would not say investigation, we can call it interpretation. But if the interpretation is now given to you as an investigation, they call it forensic audit, then you do the same thing, but do it again. When you did an audit, you can understand business at a macro level, at reasonable detail level. If you are forensic, you have to understand it at an absolute detail level. So again, you'll have to get into more detail and identify all possible frauds. How do you know what are possible frauds? Again, we have to go back to our probability and statistics. It can fail. I mean, so I'm not saying it will find 100%, but as I told you, the recent research data, if you take in COVID, a lot of failures happened. A lot of medicines they gave were wrong. Um, they basically tried everything they knew till the right combination turned. It was very fast. But if you take the studies about cholera and various stuff from 18th century, 19th century, or even manufacturing steel, wood polishes, they took me years, 10 years, 100 years, 40 years. Today, they all go in days, months. You take years, your competitor has already overtaken you. So you got to watch out. There are new kinds of frauds. Like we see cyber frauds, horrible frauds. They're new. Every time they think of something new. And then, of course, you go to the same story. But now your gathering data gets more complex, more detailed. Your technology which you use will also be very high. I mean, okay, we said data mining, we said some statistical ratios. You can go beyond that. There are called machine learning algorithms. We can use those. Okay. Now, I'm just trying to convince you on all the stories I told you. So if we had these types of ratios, this is WorldCom is an old case. We use it for our own institutes, internal audit. S&P is a benchmark, a country benchmark, Standard and Poor. Now, there are some ratios, they took valuation ratios, price earning, etc. And we have the industry, what the industry was doing, what the WorldCom was doing. Okay, the background is WorldCom was an ambitious company. There was no fraud initially. It was an ambitious company. So what I'm trying to say is not all companies are started with the intention to steal. What they wanted to do is they wanted to become the biggest company in the world for telecom. So they went on acquiring bandwidth. It's all old story, some 2000 time, okay, those years. When internet was new, leased lines were plenty, phone lines, underground cables between countries. Europe and US, a lot of cables. India also has 2 cables, one going from Chennai, one going from Bombay, the western route and the eastern route. So we have a lot of that stuff now. But the problem is they were all used for phone calls, at most some telegram, telex, something. Then came this internet and then this video business and voice calls and all that. So they started using the same carrier hardware like cables and leased lines and whatever to carry these new stuff like browsing stuff and video calls and audio calls. So WorldCom was trying to acquire more and more bandwidth. They acquired a lot of it, actually, bought up so many companies. Then suddenly they found they didn't have enough business. So they started covering up capital, revenue, showing fictitious earnings. Okay, the usual trouble they got into. That owner, okay, we'll leave the names out, Sullivan and all that. They were over ambitious. made a mess of things. And then when they wanted to get into because wireless was picking up, maybe you remember the BlackBerry and all that. So wireless was picking up. At the time, Sprint was the largest wireless transmission company in the US. Sprint refused to sell. Now, these guys didn't know how to start up a wireless complete infrastructure. Sprint refused to sell. They got into a mess. They didn't have Wi-Fi. I mean, this wireless stuff, satellite, nothing. So they got in a mess, and the whole company went on fudging books. And then, of course, there was a whistleblower. Interestingly, the whistleblower was a employee internal auditor, and then things went wrong. Okay, now the story is working with these ratios, comparing them with the national ratios, S&P, Moody's, they're all national ratios. You find they were having wrong ratios even in the early days. Now, if you go a little further down and look at this Altman Z score, actually it's called Altman, that's the name I gave you. Altman is the man who did the research. In the Altman Z score, remember we had 5 parameters. Okay, if you remember working capital, total assets, some one of the earlier slides. Now, if you take all these figures and then you have a long story there, this is the formula we had. You apply this formula to all these X1s and X2s, X3s. You end up with a number. And then we had the interpretation. I said if it is like above, I said 3. Okay, it's around 2.65. But anyway, 2 point, see, don't get too worried about the accuracy. You can take it as 3. I mean, we are auditors, I mean, we are not science students. So between this 1.8 and 2 was gray, and below that 1.8 was bankrupt. So if you take these numbers, slowly if you see the years, this number was 2.6, which is like just break even. Then it went to 1 point, got into the gray area. Then 0.7, it went below the 1.8, and go, okay, even the 1.2 is below that only. So the company's indicators of bankruptcy were very, very high. Anyway, but people didn't believe all this till this whistleblowing, SEC's investigation, okay, all kinds of stories we have. Now, is this really true? I mean, would these ratios have warned people early enough? Now, some of the things I want you to understand is when we do an audit, we think the others are also checking numbers. They are not. If you go to the finance market, the investment market, mutual funds, they're only looking at growth, breakout prices, candlestick trends, fundamental analysis. They are not looking at manipulated balance sheets, insolvent companies. They're not looking at that. But then you can ask the question, what about investors, PE funds? They are looking at future earnings because they feel a startup or some company, okay, they have a bad time, but they got a great idea, it will sell. It's only the auditor who looks at the absolute numbers. He doesn't care if it's a great idea. He doesn't care if it's a price is going up or down, share price. That can be independent of your company. So these are all the financial numbers from your whatever your annual reports or whatever financial statements. If you work it out, I've taken this from same story, Wikipedia. I just took this from Wikipedia and pasted it here. If you look at the year of default, 1 year before, 2 years before, etc., you got some big companies out here. You know all of them, Lehman Brothers, Ford Motors, all of them, you know. And if you look at what happened, see the comparison was with 3 people, S&P, Moody's, and Fitch. And these fellows have been giving them pretty good ratings, A's, and they have them CCs and all kinds of stuff. But if you look at their working ratios, these are the numbers here. Okay, the point is getting lost in the color. You can't change the color. Yes, you can't change it. Okay, I'll leave it as the pointer. Anyway, you can see the pointer. So, okay, you can see the pointer very light, right? But okay, you can see these numbers, and then you can see what happened. They got bailed out or bankrupt or sold or whatever. These are foreign companies. Fine. Now look at these Indian companies. Now these are the Indian companies. As I told you, you can also do research. You can attach yourself to a university and do it in the management department or the commerce department. They don't have a finance department. You can do in one of those two. Institute also has research capabilities, so facilities. It will be very useful to auditors in the future if we do something like this. So if you look at these companies, okay, we basically know Kingfisher Airlines because most talked about stuff. See the ratios he's got. Ultimate Z score, same story. Current year, I mean the year of breakdown, previous, etc. And these are all the ratings given by. I'm not blaming Crystal or Fitch or anyone, but basically their parameters are different. That's why today, when you want a score or a rating, you may go to these people. I mean, what do Highmark, Experian, and a whole bunch of companies are there, very big companies, international, whatever. They rate the company based on certain parameters. But if you go back and study the history of this rating, they call it FICO score, FICO, Fair Isaac. So that was the American, some group of people, they got together. It's a company score. They said, if you put all these parameters, yes, we know company is good, company is bad. But then what happened? That was about credit rating, actually. It was not for cooked up figures and insolvency and all that. But then what happened was when researchers took this up, they came out with a word called financial inclusion. Now, if you're going to give loans to self-help groups and microfinance and I mean the poor guys, so what are you going to do? They don't have all these ratings. Either they have a score or rating, individual or corporate. Okay, fine. They don't have it. So they started building their own models. If you want to refer to the models for research, refer to IFRS 9 or I mean, Ind AS 109. You add 100, we'll get the Ind AS. There you'll find, apart from your, it's called ECL, estimated credit loss. Apart from all that basic data you have something called macroeconomic parameters. Um, okay, from what I know, most of our auditors don't just bother about macroeconomic parameters, except in these rare cases I told you, the Western region where people were misusing the inflated income tax returns to claim higher loans. Okay, we have some problems with it, but they are very specific. They border around. See, the auditor raise a red flag, then you have to go forensic. So they're not technically, they are not okay, they're not what an auditor is normally supposed to do, but you can do that. Okay, so what I'm saying is, now when you go into this formula for financial inclusion, you may look at other factors because today students of data analytics will do churning, segmentation. Okay, basically churning means retain the guy, so the customer. He comes to you for a bike loan, then he's got some children dependents, whatever. Children are reaching college. You approach him and try to give him a education loan, then try to sell him a house loan, try to sell him all kinds of stuff. So the same company is selling more products to the same customer. Now, how do we do that? We do it based on various parameters, whether he got promoted, whether he shifted his locality, what's his age, I mean, number of children, lots of stuff we take. I mean, is medical data. Some of them is a little dicey because we are having a lot of privacy acts now. So maybe over the years, coming years, some data may not be available officially, but okay, unofficially you can still get it. It's fine. So that's something that this will happen, and based on that, you're not using any formula like these Brazil and Flitch and all these people, Moody's and S&Ps, and you got your own formula. They generally don't share it, but if you're doing research, obviously you know the formula. So or you're working in one of these companies, you know it. So what they do is they keep fine tuning the formula as more and more things happen. For instance, we work on consumption. See, if we take most of the software cities, metros, like say Pune, Bangalore, Hyderabad, some parts of it, Gurgaon and Noida, the consumption is very high because they spend all their money. But if you take traditionally rich places like agricultural points, we know Chandigarh is one of the richest cities in. Okay, we know a lot of stuff about that, but spending is very restricted. They'll only buy luxury car, luxury home. They're not going to go around using credit cards left and right, fancy restaurants or nothing like that. I mean, so India is building up its own data slowly, becoming, um, I mean, we are learning more and more because we're able to bring machine learning into this stuff and get the data. So what I'm trying to tell you is, you can ask the question, what were the guys in the stock market doing, all these advisors, and you invest here, you buy that, you sell this. See, they are looking more at money, return, income, capital gain, those kind of stuff. They are not looking at whether the company's accounts are genuine, is it going to last? That's more from a owner's perspective or lender's perspective. So that's why if you get into all this, I'm just copied these two because I want to convince you that yes, we do have this on some foreign stuff. We do have it in the Indian stuff also. These are done by different people who do the research. Um, okay, we need to make all this available. So before we come to our end, see, I've just taken a few things out here so that I can show you the. Okay, now if we go through this, I'm opening up different stuff, links. I've mailed the whole thing to you. All open stuff on internet. Now, this is analytics software in accounting and audit. And any of you who wants to read much more, I would suggest you refer to the AICPA, ADA, Audit Data Analytics. They have a auditing standard on that. They have 3 volumes, three booklets kind of. It was free when it was draft, but now they want money. So don't worry, it's you'll get the draft or some free upload somewhere. You can download those and read them. Don't buy anything now, just read. So this will tell you what you do with the analytics software. But remember, it's a product. They are trying to talk to you about idea. Don't worry about idea. You got Power BI. Okay, worst case scenario, you can use Excel, but keep the data small. 1,000 records are. Actually, you can download idea also. The trial version, full functionality, limited to 1,000 records. Sometimes for statistical consistency, you will need a large data, maybe 20,000 records. Excel will manage 20,000. Idea trial version won't manage. So you can have a look at this link. Now going back to the second link, see this is a blog, but also from actually idea people posted, but they put it on the Microsoft's blog. This is machine learning operations. So you can start using the machine learning, testing the machine learning on various operations. It can be done on whatever you want. It's a finance, non-finance, whatever you want to use. Application testing, you can see from the diagram that is at the bottom. I mean, of course, you have to just brush up something. Or the DSA material is you can download from the internet if you want. That will give you the IS audit part of it. You can go through it via unit testing, model testing, whatever. And finally, what you do is you get into the real-time monitoring, which is like I told, continuous controls monitoring and so on. Okay, that's another thing link you could look at. Okay, now going back to the next thing, you can also again see why did I take idea, because there was some training to be done on idea. So just pull the links out. You can use ACL, you can use anything, or you can just use auditing. There's no problem. Now this is machine learning in different sectors. Now why do we have sectors? Because we don't always do finance and accounting. You will be doing inventory. You will be doing yield in a sugar factory. You may be doing transport, logistics, multimodal hub data. You can do all kinds of stuff. I mean, India is full of all kinds of data now. You can start looking at this. And if you are looking at some kind of guidelines from the government of India, this is from the CAG. That's, the CAG, a little old, but they have newer guidelines, but not a comprehensive guideline. It's like a guide. How do you do data analytics? They didn't give any formula or methods, but they gave them some guidelines because CAG is accountable to the parliament. So they have to be careful. So, and if you have seen in the recent years, they have done this on illegal sand mafia mining. They do a lot of work. I mean, and they also, a lot of Indian government departments are consultants to poorer countries. I mean, developing countries. postal, defense, audit, so many things. So, okay, fine. This read is not a very big read, it's only 56 pages, will help you. Now, if you look at this auditability checklist, now it's a whole bunch here. You can open all the links here. Now, the auditability checklist we are looking at, see, one of the things we say is domain knowledge of the business. It's called business acumen. So we need to maintain it. So you can look at these various types of people who get into this thing and what are the audit areas, what questions you will ask. You can go through it. And again, it's the same thing here. I got another link. Okay, so this is auditing algorithms. Now, I know this, we don't have it right now in our institute, but let's assume you're getting an audit of a fully automated kitchen in a restaurant, fully automated, or you're working on some, say for instance, Chennai, we got the trials going on for driverless trains, metro driverless trains. We already know we have driverless cars and we have stuff out there. What do you audit? Now you're an insurance person. What do you audit? Normally, Motor Vehicles Act and the Motor Claims Tribunal, whatever they have, all those state and central acts, they talk about insuring the vehicle. Third party, you hit someone, they get money. You take comprehensive, third party will get, you also will get. But now it's a driverless stuff where what are you insuring? Now, who's going to drive it? So you have to insure the algorithm which drives the car. Now, is it doing it right? If it sees some danger approaching, what is it supposed to do? Hit the cheapest thing, which may be a human being not allowed. Hit an expensive thing, which may be somebody's statue in the middle of a road. That's a major crisis. But anyway, you can't kill a person. You can break the statue, so they'll build it again. But these are the problems. You ensure the algorithm for washing machines, cooking. Because many times I ask my students to go to projects on fuzzy logic in washing machines, refrigerators, cooking rice, this electric rice cookers. How does it know the rice is cooked? So it senses the heat, the moisture content. Okay, there are a lot of time users. Okay, I'm taking stuff. Life can go on. Now, when you start maturing in your audit, you may not be doing a data audit at all, but you, for instance, cybersecurity, machine learning, cybersecurity, IRDA and RBI says, not cybersecurity, it says cybersecurity and resiliency. The auditor has to sign. Okay, fine, he gets a certain empanelment, he has signed. But does he really know what algorithms are used? Is it really going to detect the problem? And resiliency means bounce back, come back in action. So how quickly will it restart? Your phones have a lot of stuff, but we don't have to audit it. But yes, banks, insurance, TRA, we have to audit. So that's why I thought this would be helpful to you. And then you also look at the concept where we have a checklist for auditing AI systems. AI is not restricted to driverless cars. It can be image recognition, fingerprint, biometric. There's a lot of stuff. How do you know the face is recognized correctly? Fingerprints are recognized correctly. There are labor contractors who commit a crime. They'll bring two workers and put one fellow's finger, the other fellow's finger. So one fellow bunks, they send the other fellow. So fingerprint will read. It takes it as alternate finger. So just go through these also. So which will be very useful to you because we are avoiding audit of algorithms and so on. So we learn and AI and machine learning in continuous controls monitoring. This is where, of course, we still teach embedded audit module, audit hooks and all that, but try to learn on the machine learning part of it. Okay. And the last of these is a case study from Uber. Was an American case study. Now, how do they apply the algorithm to get you the cheapest ride, whoever is free, to the location where the person who booked the taxi calls it? And of course, Uber has to make money, the driver has to make money, customer should be satisfied. So this is a case study. I don't ignore the maths of it. If you need any specific explanation, please feel free to mail it to me. This is our right. It's not for us. It's a US link. So anyway, that's okay. That's fine. And then I did put some book names here. It's okay if you don't read or don't read, but try to read this fraud risk assessment. It's an older book, so it should be free on the internet. It's a retired book. Copyright is over. It will be helpful to you because it's actually applicable to us in India. It's applicable because see, we still don't use prescriptive and those kind of machine learning. We're still using supervised learning, which is easy to audit. Getting into unsupervised makes it more difficult. So at some point in time, when you go to a client, he says, "I'm sorry, everything is done by the machine, so you're free to check my software." Okay, so I think we are reaching. I mean, it's 7:45 is the end, but we have moderators who will take your questions. You can note my email. It's a personal email. Feel free to, even specific doubts, you can ask me. If I don't know, I'll read it up and I'll ask some friends, colleagues. I'll get you the answers. But feel free to learn more than what I taught you today. It's not the end of the learning. It's something way beyond that. Can I now stop sharing and ask the moderators to take the questions?
Yes, sir.
Okay, yes. Yeah.
As there are no questions available on this panel, so I can conclude this session. So I can give that vote of thanks to you. Thanks to our wonderful speaker, CA Paul, sir, for appraising us, and also my gratitude all for taking time to join this session and making it successful. Thank you, sir.
Thank you. Thank you. Thank you so
Thank
much.
you.
If there are no questions, can I wind up or?
Sir.
Okay, so I can leave and thank you very much for the organizers and especially our tech support, our moderators. Thank you very much. Thank you so much. And if you have any questions, you got my mail, you can send it. And also, I'd like to thank the CA Institute for this opportunity. And thank you and wish you all the best.